And we're live. This Lula TV was freaking out on. This is actually a different computer than I normally use, and she got it today. Yay! So yeah, the Lula TV where I was going to be streaming between YouTube Live and Instagram at the same time. Turns out that it is not picking up my YouTube, only my Instagram. So that kind of sucks. So what I'm going to do is I'm going to go on Instagram, turn my live on there, I guess, and then try to sync those two up and not sync them up, but at least have my Facebook going. Not my Facebook. What the hell is this? Instagram. Have my Instagram going so that anybody who was interested on Instagram could pay attention. So I'm going to be logging into that now. To my stories. Going live. And just bear with me. I'll have this all good in about, let's see. Bam. Switch this up. Here we go. So yeah, it's pretty much the same view almost. Alrighty, so we have 2 people in here, and that's fine because I'm going to just start talking and anybody can get caught up later on. All right, so for those of you who watched my ENTP live video, I got to look at the camera. For those of you who watched my ENTP live video, like the main video on my page, I've worn a lot of hats in my life as far as trades and things that I've done. One of those was being a stock trader. I traded stocks from 2009 to 2012 with a fresh start, and then later T3, which was a broker dealer, or still is a broker dealer that exists in Lower Manhattan. And that experience actually opened me up to learning so much about how business and the stock market itself works, economic cycles, so much, because obviously they don't teach us any of this in school, especially trading. You can learn about economics if you're an economics major, learn about finance if you're a finance major, but they don't tie in the full story. And while I was trading, I got to see the growth of Facebook and that stock go public. And seeing Facebook grow and continuously get add-on funding and then go public and then purchase Instagram, all of those things taught me a lot about how business is structured in the United States, why the government is so interested in keeping the market inflated, and what does that really mean for the general public, right? And how does it all come together? Now, going back in time to 2009 when I started, it was right after the market crash, like, the beginning of the Great Recession, because the market crashed first, then the recession took hold. And, and that had a major psychological effect and true impact on the economy. And that's kind of what I want to talk to you guys about today, because it's starting to look very much like it did towards the end of the housing market bubble. When that burst, the market crashed, right? So the reason why I say it looks the same is because, markets crash off of their peaks. And we've been at historical highs for the past, I think, maybe 4 years, breaking records into new grounds. And, or even maybe more than 4 years, breaking into new grounds. And I think that, we're long overdue. Now, when I started trading, it was March 2009, right where the market bottomed out. And I learned both technical analysis and fundamental analysis. And the majority of my trading was day trading. So I relied heavily on technical analysis, which is really just looking at the statistics of stock pricing, right? And the transactions that have gone off. And there's a few patterns that you could study that suggest with a certain degree of probability that a move is coming, right? So, for instance, one of those patterns is a continuation pattern, which is a bull flag or a bear flag, right? So that means that there was a sharp or aggressive move in either direction, up or down, a holding period where there was no new supply and demand, and then a a continuation of that move. So if there was a lot of people who bought up a market, let's just say, it was pigs, right? Pork belly. And pork belly was in high demand for whatever reason. And the price went from $90 to $100, but then floated around 99 to 100, right? So that's already a 10% move, and now it's ranging for 1%, right? That's kind of like the market staying still. People hoping that the prices come down so that they can buy at better pricing, and people not willing to pay more than $100 for the pork belly. So as this holds long enough, the momentum is going to shift in a direction, whether it's going to be softening demand or increased demand, and that's what's going to push the price up and down. And I didn't know that that's how stocks function when I first started trading. Like, before I started trading, I actually thought that all publicly traded companies had to feed into one database, and literally that the ticker price was directly correlated to how that company is performing minute by minute, day by day. But in actuality, stock prices are based firmly on supply and demand, the rules of supply and demand. And when you're looking at a chart of stocks, you can clearly see what the supply and demand trend is. If there is excessive demand, prices will increase, and they may increase sharply over a short period of time. That's why the sticks are going to be longer or shorter, right? And they're obviously going to be trending in a certain direction. When demand is waning, or there's actually more supply on the market, people are selling more than people want to buy, right? The prices are going to go down, and it's going to trend downwards. So just by looking at any chart, you'll know where the supply and demand is. And what I've been waiting for, because my trading style, when I do trade, is more short selling or more in down markets, because the movement is aggressive. The movement is aggressive and sizable. You make more money quicker, and I like to be in and out of trades. I don't like to sit in a trade for too long, because then I start to overthink and maybe even think myself out of a trade. So I like when my moves come quick. I grab my profits, move on, and then I continue on with the rest of my day. I usually only trade the AM session from 9:30 till about 11. Catch a move or two if I'm trading in that time frame, and then I continue on with my day, because I don't want to get sucked into the matrix all day. Now, why am I talking about this, and why is it important for the people at ANTP Life to understand that we have entered a part of the market cycle that is a little bit dangerous and a little bit scary? And really what's been happening is that we've been in an 11-year uptrend, right? I think the anniversary is tomorrow of the market lows in 2009. So we'll hit 11 years of going straight up. Now, your average economic growth cycle is 4 to 7 years. If you look at all of the bull markets in US history, they usually last 4 to 7 years. We're at year number 11. And that's pretty good overall for the economy. That's something that we would like to see, but it's above average, a little out of the normal range, right? It's actually 50% out of the normal range as far as the length of time. And the Dow Jones was at maybe 6,000 points, a little above 6,000 points at the lows, and we've seen almost 30,000 on the Dow. So that's a 500% or 5-time increase over 11 years. That's a big move, right? A sizable move in the market. And a lot of that was stimulated by the government, right? They pumped money into the investment banks and into the banking system and into the market itself to stabilize the market, get rid of the bad debt that was accumulated during the housing market, and restore confidence, right? So the institutions got the money for almost free from the government and were prompted to support the market, right? So those initial purchases in QE1 and QE2, all of them were the institutions getting the very bottom and creating the bottom of this current cycle. And when you're investing in stocks, you're going to make money, one of two ways, right? You're either going to earn off of dividends and distributions from owning those shares, or you're going to earn when you sell and there's a spread between what you bought it and what you sold it for, right? That's the most basic ways to make money in the market. So at some point in time, the government needs to get paid back the money that they gave to the banks, and the banks need to make money, right? And everything in between the lows and the highs are people buying shares at different levels, right? Now, a big reason why unemployment is, something that's tracked. Obviously, when unemployment is high, then there's a lot of social unrest. But when unemployment is low, that means that there's a lot of people who are contributing to the overall market and fattening that market, right? And I don't want to sound like all conspiracy theorists but they're fattening that market up. And it's the players who are heavily invested that reap the benefits because they're the ones who are capitalized to invest when things are cheap. The general public buys automatically. They don't even know what they're buying because it's being administered by their 401k manager. And every single week, every single pay period, money is pouring from the working class into the market in billions and billions of dollars every single week, just fattening the market up, right? It's almost like your 401ks are the feed for the pigs, right? And the farmer is the one that's going to really reap the benefit, right? When they sell that fattened pig. So, that's why I think it's important for me to have this conversation with you. As being a member of the general public, as being a member of the general public, you're not really taught these things. And we just hold on to like the roller coaster of excitement when the market is doing well and your 401k is larger and larger, and pure depression and panic when you're seeing $1,000 moves down in the Dow Jones. So the thing is that the general public usually is overly optimistic at the height of markets and super pessimistic right before the market's going to turn over. So they end up being heavily invested at the top and selling at the bottom. And they don't know how to identify when a market is turning and when to move to cash. Okay. One of my buddies who still trades on a longer term basis, we were talking the other day, and he was like, I've been in cash since the beginning of February because things started acting strangely, right? So he moved from being fairly heavily invested in longer term transactions to a cash position, right? And he's not an institution. An institution is going to want to do the same thing because they're going to sell high, have their profits, and that's going to trigger other selling and other. It's like a domino effect. It's going to trigger more and more selling, and it gives them opportunities to buy better priced assets at some point in the future, right? But the general public doesn't look at the market that way. They'll see it in the news once or twice. Oh, the market's getting hit. They don't take any action. They don't even know how to take action. They don't even know what to do. So what I want to tell you is that if you're someone who has a 401k, has an IRA account, has some sort of retirement account, you should absolutely learn how to interpret stock charts, okay? Specifically the indexes, the Dow Jones, S&P 500, the NASDAQ index, and the Russell, right? because that will give you a snapshot as to how healthy the market is. And if you understand the technical analysis, you'll know when key levels have been broken. You'll know when things are looking, not so good, or when things are looking steady. And with that knowledge, you'll know whether or not you should be moving from your mutual funds or that are highly invested in stocks to maybe more secure assets like maybe a bond market, or even a savings. Like you can move from being invested to a cash position in your 401k. And by doing that, what you're essentially doing is what the institutions are doing, getting out for maximum profit and waiting until market conditions improve where prices are better for you to invest again. Okay. You don't want your portfolio to go from $10,000 to $100,000 and then back to 60 and wait for it to recover to 100,000 if it ever happens. You want your portfolio to go from 10,000 to 100,000, maybe sell at 90, right? You capture that $80,000 profit and wait till it's back at 60, 50, as far as the market value is concerned, where you're buying in again at a 50% discount as to where you last sold. If you're able to ride each bull wave in that fashion, you will see much more growth in your retirement accounts, right? In the Great Recession, there were people who got ready to retire. They're looking at their 401ks. They have maybe $1 million, $2 million in there. They think that's enough to live off of. And they saw their retirement nest egg get crushed, maybe brought down to 300,000, 200,000, leaving them in a position where they can't even leave their work, right? These are lawyers, doctors, people who are earning. They're like, I can't stop working because, my account got crushed. So, and it's because they don't know that predicament, and they're fairly intelligent people, right? So if you're looking to learn how to predict what's going to happen in the market with a general sense of accuracy, I highly recommend one book, and that is How to Make Money in Stocks by William O'Neill. Okay, that book will teach you one, proper investment theory. It teaches you technical analysis, it teaches you fundamental analysis, and it teaches you how to design a system to invest in the stocks and be more successful than the average person. Okay. The writer is I believe, the owner of Investors Business Daily, the publication, and has years and years and years of market research that proves that system that they have, which is called the CAN-SLIM methodology, is a winning methodology. Okay. It's not just technical analysis for those people who think that technical analysis is BS. And it's not just fundamentals. It's using both schools of thought to the best of their abilities and you benefiting from that. All right. So, that's the first thing that you guys should do, is really understand, what's moving the market, what are the institutions looking at, how to properly pick a stock, how to properly exit a stock, right? That's such a critical thing that's missing in so many people's investment strategies, is they don't have sell criteria. They don't have any rules that says my investment has failed. And what they end up doing is holding it till it hurts so bad that they either hold it to zero or they just stop looking at their accounts, right? They just stop paying attention. That happens to so many novice investors because they never learned that there's rules to protecting your investment, right? And that book also goes over that. So, before things get much worse, go over, buy either the one that's the orange cover or the green cover, because they're more recent, whatever is the newest edition, and read that book, digest it, download whatever stock trading platform you want to, download, just so you can start looking at charts and understanding how things move, understanding the symbols, just understand the language of the market. And then that will put you in such a better position. Like, even when it comes to buying your airplane tickets, travel, once you learn how the market works, you'll start looking at everything differently. The price of fruits and vegetables, the prices of fish, the prices of meats, everything starts making way more sense, man. And it's actually, I love it, because it teaches you really what is the driving force of price, period. So that's the first thing that I would recommend. Educate yourself on the stock market and use that resource, How to Make Money in Stocks by William O'Neill. Read it through and through. I trade on, if I'm trading longer term, I trade on a platform called Thinkorswim that's now owned by TD Ameritrade. The post for this video is from that platform. It gives you, good charting, good information. It executes pretty well, and is good for, you can even day trade on it. It's good for short term to long term trading. And you can do all your analysis and practice on there. And the thing that's cool about it is they have a demo on there, right, called Paper Money. So as you're learning how to trade, you don't have to put your hard-earned dollars at risk. You could build your confidence and your understanding on a fictitious portfolio, okay? And you trade that like you would real money, and then you start to build the mechanics and the understanding of what's going on. So that's number one. Number two is, if it looks like the market is tipping towards recession, you could expect that credit will contract, okay? And I feel that right now we're not there yet, but we're getting there. And I remember in my adult life, every single bear market, right? The bear market right after 9/11, the bear market of, the housing bubble crashing, the housing bubble crashing. And right before each bear market, there's this phenomenon where everybody's comfortable and happy. People are buying bigger houses, newer cars, boats, clothes, things that don't necessarily have value day to day. And they're also using a lot of debt. And if you look at the debt statistics currently, consumer debt is extremely high. You might have friends and family that just bought new houses that may seem out of their price point. Why? Because interest rates are low, so it seems more affordable. You start to see these things happen. You start to get more consumer debt offers. I get solicitations all the time of credit card applications, business loan applications. I'm getting bombarded. Like, literally, I got a warning from Google from flagging so much as spam, because I'm getting offered money so much. And it's like, well, if you're pushing money to me, that means you have no other place to put it. Because putting it, consumer debt is awful. If I go out on a shopping spree with a credit card and I buy clothes and I travel or what, the credit card company can't repo my vacation, right? A house, at least they can repossess and resell. That's an asset that they can sell, that they can recapture. A car, they could at least repo as well. And there's some value there. But when you're getting consumer debt, like credit card debt, what are people buying on credit cards? Stuff, man. Things that have no real value. So I'm getting a lot of those solicitations, and I got this right at 2007, 2008. Everything's in gravy. Everywhere I went, walk into the bank, every time I'm in the bank, they're offering me a card. You're seeing the offers for new car sales, 0% down, drive off with a car today, sort of solicitations. And those things did not exist in 2009. Money was like gone, scarce. And I got caught in that thinking of, oh man, I got all this cheap money. I'm going to borrow it. I'm going to invest in my business. I'm going to buy some things. I'm going to, whatever. And I was living very comfortably with debt, with this idea that the cycle is going to continue. And then I got rocked personally in my business and in my personal life. I got hurt from investing. Chris Dundon, what up, man? And Justin, what's going on? So yeah, so I got hurt in that cycle, and it stuck with me, right? Obviously, if you get traumatized financially, certain things stick with you. And I remember also that 2001, 2002 era, leading up to that, it was tons of credit card offers. I was just getting into college. Money seemed pretty easy to come by, and it's starting to look that way again, right? So if the banks aren't pushing their money into uh, the market anymore because stocks are overvalued and they don't think that they're going to get much money out of it, they got to rotate the money somewhere to get a yield. And that last sector that they rotate to is consumer debt. That's just the way that it goes. So if you're getting more credit card offers, you might as well take them, right? Take the offers, don't use them, right? Make sure that you have, that availability to credit, that availability to money, because usually they're going to pull back on people who have some delinquencies or they're carrying high balances. They might clip that card and just shut it off. But if you have these additional cards that are sitting at zero or close to zero, and you're managing those cards well, they're not going to pull back. So while they're giving out that consumer debt, take it, take advantage of it, but don't spend that money, right? Hold on to it because it may come in handy when assets are really cheap. Okay, it may come in handy when the pricing of housing pulls back, and you have those credit cards now to pay for materials when you're doing your rehabs. Okay, so listen, there's nothing wrong with having access to money. The worst thing is to have an opportunity and no access to money, right? I also experienced that as the market started to recover. Money, like hard money lenders, didn't have any money. There was nobody buying there was no third party buying that debt like there is now. Okay, they were either lending their direct money, which wasn't leveraged, it was just flat 1-to-1, and they had to hold on to their own debt. So they were being very picky with what they lend on, right? So I was finding deals in 2011, 2012 that were awesome. Shell brownstones in Harlem going for 700, 800,000. Right now they're going for 1.6. But I couldn't get financing because there was no money around. Okay. So you want to make sure that you have your credit squared away, bring your balances down. Start putting yourself into a safer position that if things hit the fan, you're able to not be running this minimum payment, right? Not having money just leaving your pockets to pay your interest. Bring those balances down. Create room in your credit cards so that the banks aren't lowering your limits or even closing your cards, because that will happen. And just hold tight. Okay. Start looking at before everybody's in recession mode and being cheap. Because if you think back, if you guys are old enough and you think back to 2009, from 2009 to 2004, there's people who are still talking about recession today from the 2009 recession, that the economy is not good. But people from 2009 to 2012, 13 became super frugal. People were eating lunch, from home, like leftovers. People just weren't buying as much. They were getting more usage out of their cars. And that's the psychology and the thinking that you should have for the entire time that you are, you know, hmm, I don't know, just managing your money in general. I what I learned in 2009 was to be kind of cheap, right? Always look at, what is the bare minimum that I need, right? I don't like carrying a large mortgage. I don't like carrying a large rent. I don't like having a lot of stuff. You know, like I have a few things that are like, I guess, uh, money pits or money drainers, like my airplane. But I got that airplane for cheap. I paid $35,000 for my plane. All right, and it was fully depreciated out in the first year, so I got a $35,000 tax deduction. So try not to, get yourself that $100,000 car. Stay away from that because that car is going to depreciate to zero, within 10 years or so. So don't even, Don't do that. If you're thinking about getting a new car now, look the other way, and just say, hey, let me try to get the most out of my car today, because having that extra money once things turn over is going to leave you in a much better position to take advantage of the new opportunities that arise in the new market, right? We mostly talk about real estate here. And in talking about real estate, let me see if there's any questions here on IG. Nope. Cool. No questions so far. Cool, cool, cool. All right. So um, we mostly talk about real estate here, and real estate and healthcare have kind of been what's kept me afloat with all the bad business ideas. Those two have stayed pretty safe havens for me, and real estate more so than anything else. And that's why whenever I have extra money, I buy more real estate because I can always rent it out. I can always generate, because people always need food, shelter, energy, right? Those are the things that you can count on that will always be in demand: food, shelter, energy. Okay. So, and health. People want to be alive, right? So for me, I'm heavily exposed to real estate and healthcare, and I'm also going to be looking to get more involved in food products like animal proteins specifically, and exposure to energy, which I have zero exposure to energy now. So going into the turn in the market, you want to be well capitalized and you want to have access to capital. You want your credit to be in good shape. You don't want to have that stress of making that month to month bill. You want to be in saving mode, especially now. If you're able to get out of some of your assets, like right last year when I was making my goals for 2020, I said I was going to be buying 5 properties a month, keeping the majority of them as rentals. Okay, I decided last month that the purchases that I have now, the majority of them I'm liquidating, because I'm going to be moving most of my properties to cash and maxing on my return now that the market is still kind of bloated, right? People are still buying homes. There's still fairly low inventory. Interest rates are super low. So the general public, as I discussed, they're a little late to the game always. And because they're late, they're still buying. They're still happy to buy, right? And one thing that you could look for is like people who shouldn't be buying homes, or buying homes above their budget. That's another sign that things are going wrong. Watching prices increase in subpar neighborhoods. When you start to see prices getting ridiculous in the hoods, again, those are people who are buying later. Unfortunately, minorities and where the hoods kind of sprout up, the low income areas, we're slower to build up our savings, slower to get our credit in good shape to make a move to buy. And finally, when we're in a good position, it's usually at the end of the cycle because we were never well capitalized ever. So when you start seeing the hood start to pick up in steam, I'm not calling Valley Stream the hood, but it's a heavily, it's a neighborhood populated heavily by minorities. Elmont, Queens Village, where I grew up, Brentwood, Bayshore, Central Islip. The prices are getting kind of high over there, and I'm just like, what is going on? This doesn't even make sense. I invest in those areas, and I'm looking at the prices and I'm saying, no, this doesn't make sense. The prices that I'm listing at, to me, still don't make sense. And people are buying there. But then I was looking at some properties in Westchester that are in the $1 million to $1.3 million range to sell, and those markets have slowed. And they've been slowed because the buyers who are buying there, who are better capitalized, bought 3, 4, 5 years ago, right? When things were still priced reasonably. They're not buying now. The smarter money, the bigger money is not, they're not going out and buying houses. It's the little money, the small guy who's just getting his approvals, who's just getting his credit in shape, that are buying. So, if you're kind of on the fence and you're like, hey, I'm in a position now to buy, and I want to buy, I'm gonna buy, my best advice to you is really find bargains. Please do not buy market price properties at this point. If you're buying at 70, 80%, you're doing yourself a big favor, because when the market does pull in, it is normal to pull in 15%. That's not unusual. That's like a healthy correction. And since we've been exaggerated for 11 years now, the pull in might be 30, 40%. So you want to have that insulation. So if you're all in at 70% and the market does retract, and I don't think the housing market is going to retract 30% because it's not as bloated as it was previously, and it's not as bloated as the stock market is. But if it does retract 30%, at least you're even, right? But if you bought at highs and it retracts 30%, you're gonna feel like an idiot, or you're gonna feel like you're pumping money into an asset that's not worth it. And that's something that I wanted to talk to my community about, at least, and say, look, man, if you're gonna buy smart. If you're gonna buy multifamily. That way you have other people contributing to your finances. Okay, you have someone else paying you rent to help hedge your cost. When the economy shrinks, bonuses get reduced, people get laid off, money moves around less, so there's going to be less money moving into your pockets. One thing that you could do to increase the money that's coming into your pockets is buy multifamily homes. Okay, so right now that's what I'm looking at. I'm either all the properties I'm selling are like 2 family and 1 family properties. I would keep 3 families, 4 units and higher, um, if they're priced well, right? That's my objective. Everything else is getting sold, and I'm sure not my money. So I like to have those additional streams of income coming from other people, because if business goes sour, people are still typically going to pay their rent, right? That's something that stays fairly stable. People who aren't buying homes are staying in rental properties longer because they see that the market's uncertain. During the last recession, there was an increase in rental rates, right? People were losing their homes, had to rent. People weren't buying, had to rent. So being the landlord in that part of the cycle isn't such a bad thing. Just make sure that you're buying with the intent of being a landlord. Make sure that you're buying with the intent of buying below market price. Okay. I will not buy any market rate properties ever in my life. I don't believe in it. It will never happen. I will not buy a market rate property ever. And I want you guys to have that same philosophy and same thinking. Let me see what else I would say. Um, Aside from educating yourself on market cycles, technical analysis, how to interpret a chart, keeping your debt low. I already covered that. And also, like I said, you could apply for some debt now because they're giving it. Just don't use it on stupid stuff. Okay, just hold it. Treat it as your piggy bank. If you're able to get $25,000, $30,000 more in consumer credit, park it. You might be able to use that. Like I said, it can be money that you extract for down payments when there's an opportunity. People might be doing fire sales on items just to raise money because they're like, man, this boat, for instance, this boat is draining me. I'll just let it go for the balance of my loan, right? You might be buying that boat at 50% market value, doing that guy a favor. You might want to swipe that. You hear what I'm saying? Knowing that there's a market to resell it, knowing that you're getting something below the market rate. If you don't have access to credit and you don't have cash, you're not going to be able to participate in the opportunities. You're not going to be able to buy those things that are on sale. Another thing that people are blaming the coronavirus for this turmoil. It might be the catalyst. It might be what prompts some sort of fears in the market. But, that virus is not as deadly as influenza, man. Influenza kills more people every year than coronavirus will, and it doesn't create that hysteria. It's almost like the hysteria is, like a smoke screen for what needed to happen. Major sell-offs, recapitalizing, central banks, recapitalizing the banks, allowing things to reset. I'm just not buying that. But last week's sell-off is really what prompted me to start trading again, because I love this condition. And what's unique about last week's sell-off is that we've broken a long-term trend line. Okay. And I wish I could share my screen so I could show you kind of how to look at the chart. But if you look at the picture that I posted, we have this sudden sharp move downwards. Okay. And it's like, a pretty violent move. And we wiped away, a significant amount of progress in the market in just 1 week's time. That might be, if I had my chart in front of me, that might be like a year or 2 years worth of growth snatched in a week. That's not normal. Okay. That is an extremely volatile move to the downside. That is institutional money. That's not me and you. That's not people, liquidating their accounts, their 401k accounts, and moving to cash and saying no, 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 and forcing the market down. Hell no. These are the major players, the major banks, the major hedge funds saying it's time to reap. It's time to collect and harvest our fruit. That's what's going on right now. So this is institutional, major, big selling. It could be China pushing the market. It could be, in response to the negative press on China, in response to the trade war. They could be just selling and putting this downward pressure on the market, because this move is real. This is not, light selling. It's not seasonal selling. This is aggressive selling. And in the chart that I shared, and why I wanted to do this post today, is because it's clear to me that we had a sharp move and almost a week's long consolidation, and we're bouncing off of one trend line. And if you look at my Instagram live, and I'm going to try to share some pictures of what I mean, maybe as a post or something. But if you look at my Instagram live, not live, my stories, I mark out this trend line that's like a multi-day trend line from this move down. And I said, if this trend line doesn't hold, we're going to see much lower. And by noon, that trend line gave way. Market started to crap out again. Okay. And that move is most likely going to continue for another 1 week or 2 weeks. And it's going to, as long as it stays under that trend line, we're seeing lower. And just accept that. Okay. If people are interested in me going over technical analysis to some degree, so that you can kind of understand what I'm talking about, maybe I could set up a video kind of highlighting, a few trades or a few signals in the market, how to interpret a certain stock pattern. If you think that would be helpful for you, let me know, I guess in comments or whatever. And I could go into that just so you have a better sense of what I'm talking about. And we could actually have a chart on the screen so I can kind of point out what I'm looking at. And that's pretty much it. Does anybody have any questions? In my opinion, okay, I have Jiggy here on Instagram saying, in my opinion, will interest rates drop lower? It's possible. They're pretty damn low now. And they've dropped lower last week because making money cheap makes people borrow more to do more, right? The idea of a capitalist economy, or an economy in general, is for money to move. When money moves, fees are generated. When money moves, taxes are generated. So it supports the the man, so to speak, right? People are working, people are earning, money's moving, everything is good. So by introducing cheap money, it makes people say, I might as well borrow this money for almost free. It's not costing me much to go invest in human capital, to go invest in equipment, to go invest in real estate, right? Because when that money stops moving, people stop earning, people start going crazy. So, there's been reports of, some of the European countries going to zero in interest rates or negative interest rates, almost paying people to take money. I don't know what a negative interest rate is. Honestly, I don't get how that works. But could they go lower? Yeah. But, being at 3% or even 3% and 0% are virtually the same in my opinion. It's pretty damn cheap. So if it goes lower, it goes lower. I think interest rates should go higher, just because they've been sitting around historical lows. If the central bank's only recourse is to lower interest rates and they bring them to zero, right? Okay, you do that, that buys you another year of a good economy. What bag of tricks, what do they have left in their bag of tricks if interest rates are zero? What can they do to stimulate the economy? If they print more money, they're just going to push inflation, right? They're going to drive inflation by printing more money. What are they going to do? There's there's nothing else. So and they need to make money. I mean, they're not going to want to be who wants to lend money at even? Nobody. So they're going to need to get interest rates back up. That's why maybe last year or 2 years ago, last year, 2019, they were inching interest rates up, and Donald Trump is going crazy about the Fed is messing up, they're hurting the economy. I mean, that's not what was doing it. I wouldn't say interest rates are yeah, 3.12%. Listen, I've got properties that have 6.5% interest rates. I've got properties from 2007, 2008, 2009, 6%, 5.5%. Make you gotta make it work with where you're at. If it makes sense for me to refinance, I'll refinance them. If not, then I'll just stay put. Maybe I don't want to extend the life of that mortgage. Maybe if I have 20 years remaining on the mortgage, interest rates get low enough that I can refinance to a 15-year mortgage and be paying the same monthly, bill. I'll take that because I'm going to pay it off quicker, and I'm already managing that property on this budget. Then I'll move to that and kind of speed up my process. Maybe cash out a few dollars. It really depends. But interest rates are good. Just buy smart. Buy cheap assets. Andrea Focal Point. What's your recommendation to prepare for the recession? Um, don't spend money foolishly. That's the number one thing. Pay down your debts, especially your revolving debts. Not like student loans. Student loans aren't really going anywhere. I have this thing about paying the damn minimum on student loans because their interest rates are low, and when you pay off your student loan, you can't tap it again. Right? You pay off your house, you can at least do a home equity line of credit or refinance and get that cash again if you need it. You pay off your credit cards, you can swipe again if you need it. You pay off your student loans, man, you can't get another student loan unless you go back to college. You get what I'm saying? So, but my recommendation is definitely bring down your debt. You don't want to have money leaking because you're paying high interest on credit cards and those sort of things. Get more life out of your vehicle. You don't need to buy another depreciating asset. Um, I would look to kind of get assets that generate income, like real estate, like maybe some heavy equipment you can get some income out of. Except if we have a recession, things like trucks, they're going to be shipping less product because people are buying less things, and so I preparing for a recession for me looks like keeping my expenses low, paying off, revolving debt that has high interest, and trying to save up and shore up as much money as possible, including applying for more consumer debt so that I have it just in my war chest. So that if I need to use that money to buy an asset that is actually a performing asset, I have something that enables me to do that. Okay. When money is running thin, like in a recession where the banks aren't lending, the central banks aren't pushing more money into the economy, when you have cash, you're able to take full advantage of whatever the opportunity is. So that's my overall advice for a recession. Make sure that you're moving yourself into cash positions, you're moving your money into safer places, and you're kind of just holding tight. Okay. Be frugal and hold tight and educate yourself and watch where money is moving. Because if you see the market is tanking, money's moving into bonds, money is moving into the US dollar, money is moving into gold and some other commodity plays. Okay. Money just is going to keep rotating like that, right? When the stock market is good, you'll see gold prices going down because people are moving their money into the market and moving their money into equities. So you want to start learning how to follow where the money is flowing to, because it's like a balloon, right? You squeeze it here, it's going to bulge out over here. So you see the stock market coming down, you're going to see gold going up, you're going to see the dollar going up, maybe against some other world currencies. I mean, the euro has been cheap for a while now, but you'll see those sort of things happen. But best advice: be frugal, take whatever consumer debt you can right now, preserve it. Don't max out your cards. Bring your credit card balances really low, below 30%, because you don't want to be shut off, right? You don't want to be sitting around 60, 70%. They continue to be high risk during a recession. They're nervous about you. They cut your limit and they even suspend your future charging, right? So even as you pay it down, you can't even tap that money again. It's now like a student loan. So make sure that your credit starts to look good. Bring it all down. And if you can raise your limits now, then make that request. Hey, I was looking to raise my limit, right? Okay, they're gonna raise you, bump you up 5K, 10K, whatever it is. It's good to have. Hopefully they don't, if you're managing it well, they usually do not pull it away from you. Okay. It's those who are over leveraged, those who are mismanaging their credit cards, that will lose even the little balance, like the little room that they have in there, and then that you don't want to be in that position. Barty Bart, thanks for agreeing. Long Island Luxury Homes at La Rosa Realty, New York. KP. I'm guessing that's Felix. Welcome. Yeah, man. It's a bear market gets me going, man. They poked the bear for sure. Any other questions? Because I'm working on an hour here. All right, cool, guys. No, I can't. I didn't go through any charts, man. Felix was asking me if I went through any stock charts. The only chart that I have posted up is that SPY chart, the S&P 500 ETF. And I can't be live and screen share, at least on YouTube direct. I would have to download another app and kind of do it that way. But it's something that I want to show. I think if people don't know the basics of stock charting, it might be a little over their heads in a way. Um, do I think Trump will susta? Will susta? I don't even know what that means. Do I think? Yeah, Barty Bart is saying that there's so many opportunities in a bear market, and it's true. It's just that you need to be in a position to take advantage. If you think like a consumer, the bear market will feel, awful. It will feel like you're getting bit by a bear, right? Um, but if you're a little more savvy and you have some capital, you'll see opportunities. You'll see people who mismanaged their debt, mismanaged their income in situations. And you don't want to take candy from a baby, but you'll find people who need to price their assets aggressively to recapitalize or even get themselves out of a jam. All right. So you want to be in a position to one be able to identify that that's what's happening, being able to identify, well, this is a really good price for this house. I'll buy it here. And then two, you want to have the money and the credit worthiness to make that transaction happen. There's nothing worse than seeing an awesome deal and just being like, man, I'm just too broke to get it. There's certain things that I see, you know, and I'm like, damn, I'm too broke to get this, and I'm in a better position than most people. So when it's recession time and things are really kind of at a discount, and you could identify that things are on sale, you want to have the money and the ability to do something. Do I think Trump will sustain a bull market for 10 more years? No. I don't think any president can do that, man. If a president can do that, every president would be using you know, the same trickery to do that. I think what allowed this bull market to continue for the way that it has is because we pumped a lot of money into the hands of the banks. The banks made some pretty wise investments, and I think from there, also the world economy was pretty crappy too. So a lot of foreign investment came into the U.S. So there was a lot of money that was moving into the U.S. either because of the safety of the dollar or the perceived safety of the dollar, um, and the fact that our government was doing something to try to stimulate the economy again. So I think that's what really pushed us for the past 10 years. I don't know what else our policymakers can do to fuel 10 more years of growth. Maybe if a war breaks out and we're not participating in it, I don't know, maybe. I have no idea. I don't know. I mean, if I could predict that well, then yeah, I'd be killing it. Who's the next Washington Mutual, in my opinion? Um, I don't know. I think Washington Mutual, when they got when they got themselves in trouble, they were doing what most of the people in the industry were doing at that time. They were just lending like crazy. I don't know. I don't. Maybe it's the central banks, man, that find themselves in that position. I have no idea. I Who's going to be the next one? I think if I was studying, like, I guess, the financial statements of banks and really having that level of access, maybe I would be able to know. But I don't know which banks that are that the size of Washington Mutual that have very loose lending policies. I don't think that's going to be what hurts the economy. It's like, banks messing up. They've been so tight for the past 11 years with their lending criteria. It's a lot harder to get money for anything than it was from 2003 to 2007, right? 2008. Those years were different. Lending was so super loose compared to now. So I think they've learned from that cycle. So it's going to be something else that's like the contagion. Olamide, how will this coming recession and bear market affect the home health industry? Um, well, I think what happens what happens in home health is not much. The the things that that hurt you is having limited access to financing, right? When banks start to tighten up and you're seeing, oh man, there's more uh, there are more people who are unemployed, right? Like right now, unemployment is historically low, right? Which means anybody who's on the job market is either moving from a position or just not worth hiring, right? I'm in the process of hiring for this new company, this new home care company, Aidbook down in Fort Lauderdale. We actually start interviews tomorrow, and the quality of candidates is mixed. We got a few good ones, a lot of crappy ones. During an economic downturn, I see more talent because companies implode. You get more talent, more experience on the market. But as far as like cash coming in, there's two ways that it can hurt the home care market. One, you don't have access to borrow money, so that when there's opportunities, either home care companies failing, you can't borrow to buy them. And two, you the austerity of the government, right? Because we get fueled by Medicaid dollars and Medicare dollars mostly. So if the government has to do budget cuts, they are going to be looking to cut from maybe cut reimbursement rates or cut entitlements to a certain way. They usually don't like to cut Medicare and Medicaid because that's going to affect, the voting base. Nobody really likes to do that, but that's where you could see things change, where they they might, some states might put a cap on how many people could be on Medicaid, right? It's like we only have 5 million Medicaid vouchers statewide, right? When they start doing things like that, that means that people who could have qualified, that could have been your customers, can no longer qualify. So you're not going to see growth in your, you know, organic growth because there's some sort of interruption in how many people have access. So those sort of things may happen. But in general, people still get sick, man. People age, they get sick. I think home health is going to be strong for the next 10 to 20 years just because that baby boomer population is aging and they're going to need services. So, I'm not so worried there, but I do know that that getting money, if things get really tight, finding cheap money to make major acquisitions may be a problem. Or money, even if you're functioning, let's just say this is what happened to me in 2008. Economy is falling apart. I was in my staffing company, and in my staffing company, I was dependent on a line of credit to float my payroll while I'm waiting on reimbursement rates. I'm waiting on reimbursement from my vendors. Okay. Some of my nursing homes were paying me a week from the time that I issued an invoice. Others were paying me 30 days, 60 days, 90 days, some 120. So my line of credit was critical for, floating those longer vendors, right? Those slower paying vendors. When they pulled my line of credit, I was screwed because I could no longer service those loans because I couldn't afford to pay these nurses and wait, 120 days to get reimbursed. I mean, that's a long time to wait. So, that's one thing that could affect you, if especially if there's long lead times. Another thing is the payers, the insurance companies, the hospitals, nursing homes, whoever you're servicing, they may be on a net 30-day and change to net 60 just to buff because they're hurting because they're losing their loans. So they need to do something to change their financial cycle, right? To say, you know what, we're paying our invoices in 60 days, effective immediately. And then you have to deal with that. There's a lot of high-rise condos going up in Miami and Fort Lauderdale. There'll be a lot of vacant buildings if the economy tanks again. Yeah, I'm in Fort Lauderdale, man. I'm seeing them. I right now I'm on Los Olas in downtown Fort Lauderdale, and I live right here. And every morning I'm walking around and I'm seeing buildings going up, and I'm like, man, this reminds me, this reminds me of '07, '08. And I hope that those developments are fully capitalized, because if the money starts to dry up, and that's what happens, recession comes, everybody's like, oh, let me pull my money to myself, let me hoard it. Then there's going to be projects that aren't fully funded that will end up going incomplete, right? And only those who are well capitalized will turn around and buy that concrete and steel and finish those jobs and make the money. So that's just how it works, man. And the more cycles that you experience, and you have your eyes open and like, oh, this is what's going on, the more you try to prepare yourself and position yourself for those opportunities when they come. It sucks to see it happen. It sucks if it's you, but if it's not you and you're prepared, then you'll be able to tap into that and make some money. For me, I can't. I don't have high rise money. I might have a plan to get high rise money, but I currently don't have it. So I'll be looking out for like those 10 units stuck, incomplete, or other flippers did, who just bought way too high, holding on to properties at 12% interest for a year or 2 years. I'll take that off your hands. That's what I'm waiting for. But we never know how soon it's going to be. I just know that right now the market is selling off, and it's real. It's not something to be lighthearted about. Like, even what prompted me to do this was that I saw people talking about the sell off, and they were like, "Oh, I think it's a good time to buy. Stocks are cheap." And I'm like, relative to what? Relative to last week, they're cheap, or relative to this this super move that we're off of? They're not cheap compared to this super move. They're not even cheap compared to last week, because that was still overpriced. So that made me realize that there's a lot of people who don't get it, and who are even thinking about putting money to work in a market that they don't get because they see it bloated. That's another sign that it's the end. When people who have no business investing are investing. I see it happening in real estate. I obviously see it happening in the stock market. People just taking shots where there's people who are who, this is what we do. We are professional. We understand what's going on, and we're not being active. And there's newbies coming in. It's just, it's sad actually, but that's how it works. Let's see if there's any more questions. Do you think it's a good idea to get a HELOC now that homes are valued high? Yes, FG. I think it's a good time, because the thing is, with a HELOC, you might pay on the origination, right? You're gonna pay some recording fees, but you now have access to that, right? And as long as they don't take it away from you, it's there. So it's what you decide to do with that money. Like, so let's just say housing prices are high, right? You have a house that is, I don't know, worth $500,000 now, and your balance is 250, right? And I don't even know what the ratios are in HELOCs right now, because I can't get one on my investment properties. But let's just say you're at 50%, right? And it's a $500,000 property, you're at 250, and they're letting you borrow up to 80, right? that means that you can borrow or have 150 access to your equity, right? What would you do with that 150,000? You're only paying on it whatever if they have an annual maintenance fee, okay, you're paying the annual maintenance fee, and you're only paying on what you're drawing, and you're paying very low interest. So that would be good to have like on deck when you see a really good opportunity. If you see a really good real estate deal and you could just use a HELOC immediately, just draft it, make the transaction in all cash, and let's just say it's a property that's doing 20% a year, right? Like it's spinning off 20%, and you're paying 3%, 4% on your HELOC. It makes sense to make that spread, right? You're going to be able to service your debt no problem, and you're going to be earning money. So if you are looking to get a home equity line of credit rather than a refinance, because well, I'll say it in two ways. If it were me, I would do a home equity line of credit because I will only be paying like a credit card. I'll be paying a interest payment and a principal payment on what I draft, right? Because it's a line of credit. I pay on what I draft. The only thing is, if you have a bank that's going to be willing to take that away from you or reduce your limit because the market is in turmoil, then it sucks that you never got to use that money and they took it away from you. Meanwhile, if you had a refinance and you just cashed out and you said, all right, I'm going to cash out and park this money up in a savings account, for instance, then that money is with you. They can't take it away from you because they already gave it to you in full. So, I guess it's a matter of what you're comfortable with. If you know that you're going to be putting it to work, then do the refinance and that's it. If you're just going to be having it there as an option of money that you could tap to take advantage of future opportunities, I think it's a good idea. Let's see if there's any other questions. Oh, no problem, man. I like doing this because it's mental exercise for me, and it also helps me see what the public is thinking. And that's like another my public opinion indicator. You said you're in the middle of something where a flipper has the house too long and the rate is 27%. They pushed them to the default rate, bro. Yeah, you email me this guy's information, please. I hope you're joking. That's such a crazy situation. Are you for real or that's a joke? FG Felix. You for what? Can you just type me what's the story behind this? Just please in the chat. I'm curious. This guy had the property too long, and his rate is 27% now. What is he? What is the project done? Did he miscalculate the renovations and he's just standing still making interest payments? I don't understand. How did this happen? That's crazy, man. 27%. Yo, he needs to do something. Please, man. I'm waiting. I really want to hear this. 20%, 27%. Imagine having a 20%, 27% interest rate on a $500,000 loan, man. Whoa, 135K in interest. Oh, they're they're looking to they're they're looking to get their money back. Is what they're looking for. They're like, yo, this guy is in this deal for too long. He's got to refinance me out because the market's looking like trash, and I need my money. And if he can't get it to me, then I'm going to eat on this interest. Jesus, that is phenomenal. I'm waiting on you. Okay, he driving. All right. As Felix types up his explanation of what's going on there, that's pretty interesting. Oh, yo, Smoker, let me tell you, it gave a lot of people PTSD. A lot of people got PTSD, man. Um, and it's kind of it's good in a way, right? Because when you get traumatized like that, I mean, you're either gonna just be traumatized for like a person, right? You're gonna be traumatized and you can't function in society, or you're gonna try to understand your trauma and know how to better deal with it, in the future. Um, 2008 was rough, man. There was a lot of people. I learned some lessons. So the first real estate transaction I was ever involved in was in 2006, and money was cheap, easy. They were giving out loans like you know flyers, and um, we didn't abuse the home equity line of credits at that time. Had we would have been rinsed, and maybe even thought real estate is not the move. And then we saw the people who were buying a house in 2006, refinancing it for a $75,000 cash out, 8 months later to then buy a car. We saw that happening, and luckily for the group that I was with, it was like, yo, we can't rent this house for more to support this payment. Like it's just not possible. How are we going to do that? And we never went for those offers. But man, we learned, man, a lot in that time, seeing it all blow up makes you say, oh, okay, that's how that happens. Um, so yeah, man, yeah, send me all the info on that property. I'm pretty curious as to how it's working, and if it's even worth trying to get him out of it, because now he's in a jam. So let me explain to you, if I can, what Felix is talking about here. Felix is a real estate agent and former stock trader, and Felix is saying that he knows someone who has a hard money loan, I guess, on some sort of investment property. And usually the hard money loans, what they do is they'll have like a 12-month term or a 1 year term where the payment is due in full, like a balloon mortgage, right? So it's interest only for the time that you're borrowing the money, and then it's a balloon payment at the end, right? Either when you refinance before the end, or you sell the property, they get paid out. They don't want their money tied up for more than a year. Some of them will give you extensions, like you could do a 3-month extension, a 6-month extension. Some of them may just keep extending you. This lender probably had a clause that said at 12 months, you might have one extension of 3 months. After that, it's considered due in full, or you are in default. And the default interest rate is now the maximum, which is damn near 27% in New York. And that's it. So pay us back or get crushed by this interest. And we'll make our money either way. Or once you stop paying, we're just going to repo this property and figure it out. And it's kind of mean, but I mean, that's what he signed up for. And maybe he didn't know how to navigate what's going on. But the cool thing here and the opportunity, and this is, why if you're well positioned when these sort of things are happening and these not so savvy investors are participating in this market right before the recession, these guys, when they borrowed, they were borrowing at 65%, or the lender was lending at maybe 65, max 75% of the total project cost, right? Or like, no, 75%, 65 to 75% of the after repair value is the maximum that the lender would lend. So if this project is finished or close to finish, right? And he might be in for 20%. So let's just say this was a $500,000 project, right? let's just use an even number, $100,000 project. Um, or no, let's just say the property had $100,000 after repair value. Okay, the hard money lender will say, I'll lend up to $65,000 on this, right? But you got to be in this deal for at least 20K, right? So let's just say, if that was the case and this total project was $85,000 to buy it and repair it, the buyer is in for 20,000, the hard money lenders are in for 65, right? Repaired is worth 100,000. He gets to this point where he defaults as described. He defaults as described, and he now is paying 27% on almost 100K, right? So he's got a $2,700 or so payment a month, something like that. So what will happen is he's going to be in a situation where it's like, yo, this property is costing me money every month. The 27% interest, the insurance that I have to carry, the taxes that I have to pay, I'm getting rinsed here. What is he going to do? He's going to just be happy that somebody like me comes along and says, yo, man, I'll take the pain away. I'll pay off the mortgage balance. You just got to give me the property, bro. And I'm going to get it at 65,000 when it's worth 100, almost complete. Maybe I put another $5,000 in there and I can refinance it or sell it. Or maybe I might say, hey, man, I'm only going to give you 50,000 for this or 45. Because if you keep this for another year or whatever rate you're going at, you're going to be hurt. So you might as well let me sell it for 50,000. If you have 15,000 sitting around, you pay the rest, and that's it. And now you get that property on the cheap. And that's just the way that it works. And that's the importance of being prepared for that recession or those opportunities. Because right before the recession, remember as I described, right before the recession, the public and the not so savvy people are overspending. They're either investing in things that they shouldn't be investing in because they don't know how to invest, or they're buying crap, right? Either way, when money starts to dry up and there's less of it, they're not using a credit card to pay for a credit card or using a loan to pay for their debt, right? Once all that expires and there's nothing left and they're only dependent on their income if they still have one, and they have these things and they're in a state of, oh my God, I can't pay for it anymore. They're going to be so desperate to get that payment off of their backs that you get bargains no matter what, because they've already put money in, they've already put some elbow grease in, and that's how you pick up an asset on the cheap. All right, guys, I've been at this for an hour and 23 minutes. I got some work to do, and then I got to go home and cuddle. So if anybody has any last questions, please ask them now. I'm only going to stay on for 2 more minutes, and I'm signing off. In this time, if you're still here and you're not already a subscriber, please make sure you subscribe to this channel, ENTP Life. If you're not following me on Instagram, follow me on Instagram. It's ENTP _ life. I just post things every now and then. It's more my day-to-day lifestyle, I would say. It's more the lifestyle of me in my stories and some posts that may trigger thought. So follow me there. Share this with your friends. I tell people all the time, subscriptions matter. Likes matter. Comments and engagement matter. But if you could share these videos to your friends and family, people that you know would be interested, that's probably the biggest, form of appreciation or the best thing that could happen. Because you share this to your social media, you got 100 people following you or friends, it exposes me to maybe 3 more people who are interested in what we're talking about here. So, if you can, share and like and all that stuff. A couple other housekeeping items. I have some pretty cool videos coming up, man. I got my trip to Sicily where I went to pick up a euro home. There's these euro. They're selling homes for a euro in Sicily. So obviously, I got 2 properties out there. I'm going to be documenting what that. I documented what that process was like. So I'm going to be posting that here, so you know what the process is like, what to expect, what type of properties I got, and what my plan is. I'm going to show the renovations of that. It's my second and third international property. I have a property in Medellin, Colombia. Now I have my 2 in Sicily. And I just need to get properties in 9 more countries, and I'll have 12 countries covered. So that's my goal for self. Yeah, I got that coming up. I have a series on how to start a home healthcare agency. I filmed the first episode yesterday, so it's just a matter of editing and getting that up. So that should be coming out soon. So those are 2 that I like. Now, for those of you who are interested in the home healthcare stuff, I'm that's going to be some heavy content here, because what I'm doing is I'm starting a new home care agency, and my plan is to take this to a major acquisition and ideally to a public offering. So now that I have, 20 years plus in healthcare staffing and home healthcare combined, I have a good sense of what I need to do to take my practice from mid-size business to full-on enterprise level. So I'm going to be showing what that process is like. And the thing is, whoever's following and interested can follow to as far as they want to get, right? If you're thinking about just having a small healthcare staffing firm or home healthcare agency, by small, I mean like $1 million revenue a year, maybe you make $200,000 profit on that, something like that. If you're interested in just getting to that size, you'll follow it through and follow my methods that will allow you to get to that point. If you're more interested in getting to like the mid-market size where I am now in my company, where we're doing about 12 million a year, at least last year. This year is looking pretty awful, but last year was 12. So that's like the mid-tier. And then like, the enterprise level are companies that are doing 100, $200 million annual rev, maybe even higher. And that's the level that I want to hit next, right? I've already got the mid-tier done. I already did the mom and pop size. So now this journey is from beginning. This is new office. We've been here in Fort Lauderdale since January 2nd. Just starting the licensing process. So I'm going to be showing what that journey is, from how to get the license, what my marketing strategy is, putting together the team, website, all those little details that go into forming a company, and one that has a foundation for scale is going to be going down here. So I'm hoping to put out maybe going forward like 2 to 3 videos a week. One will be real estate related because I still have that operation going. That's not going to stop. One will be definitely the home healthcare agency, and maybe the other will be, depending on the week, personal interest, flying, fishing, whatever the hell it is that I'm doing. I'll post that, and that's pretty much the mix. All right, guys. Thank you very much for joining me here at ENTP Life. I hope you learned something. Hope you enjoyed. And stay tuned for those videos I told you about. Have a good night, guys. Later.